Hi everyone, welcome back. Now let's quickly summarize our discussion on trade date accounting and settlement date accounting. In case of trade date accounting, under purchases, on the trade date, we are going to recognize an asset and a corresponding payable. All right, we recognize the financial asset and the corresponding payable balance. After that, we are going to classify the asset either under the amortized cost category or the FVOCI category and the FVPL category. We are going to classify this financial asset into one of these three categories. If it is the FVOCI or the FVPL category, we are actually going to fair value it on the balance sheet date. All right, we are going to fair value it on the balance sheet date where the mark-to-market gains or losses could be recognized in other comprehensive income or in the P&L account as the case may be. If it's FVOCI, it will be recognized in other comprehensive income. If it is FVPL, it will be recognized in the P&L account. On the settlement date, the liability that we created earlier is going to now be settled. Therefore, we debit the liability and show a corresponding cash outflow. That is the first journal that we post under the settlement date accounting. In addition, if we are categorizing the asset at FVOCI or FVPL, we are also again going to post an additional journal whereby we're going to fair value the asset once again. On the settlement date, we're going to fair value the asset again under the FVOCI or the FVPL category, and the corresponding gains will be taken to OCI or the P&L as the case may be. That is with regard to purchases. With regard to sales, you will de-recognize the asset on the trade date. On the trade date itself, you de-recognize the asset and you recognize a corresponding receivable balance. I will show a receivable and I credit the asset. And finally, on the settlement date, the receivable is credited and you actually have a cash inflow, and therefore your bank account is debited. All right, so under the sales, you first de-recognize the asset on the trade date itself and you show a corresponding receivable. And then on the settlement date, you credit the receivable and debit the cash account. That is how you account for sales under the trade date accounting. Once you de-recognize the asset, you're no longer bothered about the fair value fluctuations that actually happen. That is with regard to trade date accounting. Let's move on to the settlement date accounting. With regard to settlement date accounting, in case of purchases, we are not going to recognize the financial asset on the trade date. On the trade date, we're going to pass no journal entry. The financial asset is actually going to be recognized only on the settlement date. And directly, we recognize the cash outflow. We recognize the financial asset for the first time on the settlement date, and we credit the bank account directly without recognizing a liability like how we did in the trade date accounting methodology. However, if there is a balance sheet date between your trade and settlement date, in the example that we did in the previous lecture, we had a trade date of 30th of March, we had a settlement date of 1st of April, we had a balance sheet date in between of 31st of March. Where you have such a balance sheet date between the trade and settlement date, and if the asset is classified either under FVPL or under FVOCI, then we recognize a temporary asset on the name of fair value adjustment. We are going to recognize a temporary asset in the name of fair value adjustment, whereby I will recognize the fair value fluctuations that have happened between the trade date and the balance sheet date. I am going to create a temporary asset with the name of fair value adjustment, whereby I'm going to recognize the fair value fluctuations between the trade date and the balance sheet date. In the example that we actually did in the previous lecture, the fair value on the balance sheet date was $107, and the amount that I paid, including the transaction cost, was $102. Therefore, there was an incremental gain of $5, and I recognize that incremental gain of $5 either in P&L or in other comprehensive income. P&L if it is an FVPL asset, and OCI if it is an FVOCI asset. Why are we actually doing this? We are doing this to ensure that the net P&L that is reported under trade date accounting is actually equal to the net P&L that an entity would report under settlement date accounting. We do not want the P&L and the other comprehensive income to be different under each accounting policy choice. We want it to be exactly equal, and that is the reason we're recognizing this fair value adjustment. Now, in the example that I had taken previously, the fair value on the balance sheet date was $107. What if the fair value was actually lesser than $100? Let's say, what if the fair value was, say, $90 on the balance sheet date? I had $90 as the fair value on the balance sheet date. The amount that I agreed to pay was 102, including the transaction cost. Therefore, there is a loss of $12. I would have recognized this loss in P&L or in other comprehensive income, and I would have credited a fair value adjustment, this time a liability account. If it is an asset, I mean, if I have a gain, it will be an asset account. If it is a loss, I will recognize it by the name of fair value adjustment liability account. All right, that would ensure that the P&L under the trade date accounting and the P&L under the settlement date accounting would actually be equal. In case of sales, under settlement date accounting, sales, you will de-recognize the asset not on the trade date, but you will de-recognize it on the settlement date, and you will directly debit cash account rather than debiting receivable account like you did in trade date accounting. Here, you are actually going to recognize the cash inflow directly, and you will de-recognize the asset on the settlement date itself. Again, if there is a balance sheet date, all right, let us say you have sold an asset on 30th of March. You have the settlement date happens to be the 1st of April. Therefore, you've got a balance sheet date between trade and settlement date. In case there is such a balance sheet date, the fair value fluctuations between 30th and 31st are supposed to be ignored. All right. Once you entered into a contract to sell the asset on 30th of March, any fair value fluctuations, although the asset is continued to be shown on your balance sheet. Remember, you have not de-recognized the asset on the trade date. You're going to de-recognize it on the 1st of April. Therefore, on the 31st of March, the asset is still shown on your balance sheet, but you will not recognize any mark-to-market changes that happened after 30th of March because you have actually sold off your asset on 30th of March. You are no longer entitled to the rewards from that asset, although you are showing that asset on the balance sheet date. I'm again repeating myself. Let us say you entered into a contract to sell the asset on 30th of March. On the 1st of April, the contract is going to get settled. In between, you've got 31st of March being the balance sheet date. All right. Between 30th and 31st, maybe there would have been some fair value fluctuations that would have happened in the fair value of the asset. Are you going to recognize the fair value fluctuations? The answer is no, because you have entered into a contract to sell it on the 30th itself. All right. You are not going to de-recognize the asset on 30th. You will de-recognize the asset on 1st of April when the settlement happens. But although the asset is on your balance sheet on 31st of March, you will not recognize the fair value changes between 30th and 31st because the asset technically no longer belongs to you. All right, all the risks and rewards have actually been transferred out, and you are therefore not going to recognize those fair value fluctuations which happen between 30th and 31st. All right, therefore you do not recognize the changes in fair value beyond the trade date. Beyond 30th of March, if there are any fair value fluctuations, whether it is a gain or whether it is a loss, you are not going to recognize it because you are not entitled to receive the same. You have entered into a contract to sell the asset at a particular price on 30th of March. What happens after that, you're not going to be bothered about it. Although you are showing the asset on your balance sheet, you have not de-recognized the asset, you're still showing the asset on your balance sheet, still you're not actually bothered about the fair value fluctuations after 30th of March. That is how you would actually account for sales under the settlement date accounting. Just a last thought that I would like to leave you guys with. Let us say I'm actually having an amortized cost asset. The carrying value of the asset in case of an amortized cost does not include fair value fluctuations. All right, let us say, so the asset's carrying value in my books, say, is $10,000. And I enter into an agreement to sell it for $10,100. I enter into an agreement to sell it for $10,100. If I was following the trade date accounting, I would have actually recognized that gain on sale of asset in the financial year, in the current financial year itself, which is because I am de-recognizing the asset on the trade date. I recognize a receivable of $10,100, and therefore I have a gain on sale of $100. Whereas if I'm following settlement date accounting, amortized cost approach, I continue to show the asset at $10,000 only. The $100 gain is actually going to happen in the next year. It's going to actually happen in the next financial year. That is a slight loophole between following, I mean, I wouldn't say loophole, but it's a gap between following trade date accounting and the settlement date accounting. The $100 gain would have been recognized in the current financial year in case of trade date accounting, whereas it would be recognized in the subsequent financial year if you're following settlement date accounting. You will not actually have that problem in case of FVPL and FVOCI asset. because in case of FVPL and FVOCI, the asset is going to be measured at fair value. Therefore, the fair value mark-to-market gains or losses is going to take care and ensure that the P&L and OCI are actually the same. Whereas that doesn't happen in case of amortized costs. Quickly repeating, I'm just leaving you guys with a thought, not a very important one, but I thought I'll just give it a mention. Under trade date accounting, if you're selling an amortized cost asset whose book value is $10,000, you're selling it at $10,100. The $100 gain will be recognized in the current financial year. If you're following the settlement date accounting, the $10,000 will be continued to be shown at $10,000 only. You're not going to obviously market to market. You're not going to recognize it at fair value. The settlement is actually going to happen in the next financial year, and therefore in the next financial year you will actually end up recognizing the $100 gain. This is a gap between trade date and settlement date accounting, but we got to live with it, and that is not going to be a problem for FVPL and FVOCI category, because the fair value fluctuations will actually take into account the gains or losses, and it will ensure that there is no difference between trade date and settlement date accounting. All right, that's it for this lecture, guys. Thank you so much. Bye bye.